Hello and welcome to HOKA Investment. This analysis is for Deckers Outdoor on the New York Stock Exchange as of 15th of August 2026 with a share price of $93.09. The full report is on dohnatien.ca. The base short signal is buy, capped by the technical confirmation rule. Monthly, weekly and daily are all confirmed downtrends and no entry path is open. Take the two directions in turn. On price, this got cheaper, down another 3.1% to 93.09 against a warranted multiple that barely moved. 13.24 times trailing earnings against a warranted 20.4 is a ratio of 0.65 from 0.69 last time, and the valuation score rises 10 points to 80. The balance sheet is genuinely strong. $1.13 billion of net cash, interest cover of 328 times, and a free cash flow yield of 7.5% on enterprise value. There is $4.7 billion of buyback authorization outstanding, 37% of the market capitalization. Against that, the business red got worse, and the fall is attributable rather than drift. In the identical quarter ended the 30th of June, HOKA grew 7.7%, while on-holding grew 13.5% as reported and 21.6% in constant currency, and Nike's running category grew more than 20%. HOKA had halved its own growth rate in a single quarter. Switching costs and cost advantage inside the moat scorecard were both cut on that evidence, taking the moat from 59 to 53 and business quality from 78 to 70. Gross margin steps down to about 56.5% for the coming year, from 57.7%. One correction, disclosed rather than quietly swapped out. An earlier draft of this report cited a run specialty channel dataset as evidence that On was taking share from HOKA. That dataset was published in December, covers the 12 months to September the year before, and is roughly 11 months stale, and it actually shows On at minus 19.7%, worse than HOKA's minus 7.4%. It says the opposite of what we used it for. An independent audit caught it as a blocker. The finding has been re-derived from period-matched company reporting for both companies. The trajectory conclusion survives and the scores are unchanged, but the evidence for it has been replaced, and the stale figures now appear only as disclosed counter-evidence. The bear needs two correlated things rather than two independent ones, and the report should say so. The competitive leg, On and a resurgent Nike squeeze HOKA from both ends, and its growth decays from 7.7% toward flat, and HOKA is 69% of this company's revenue. The consumer leg, July's minus 0.6% retail sales and a sentiment reading of 51, turn out to be the start rather than a wobble. Direct-to-consumer growth compresses, and 126 days of inventory becomes markdown risk. That takes gross margin below the guide. $78 is minus 16% and a test of the 52-week low. Behind it sits about $150 million of unmitigated tariff impact, quantified from the company's own guidance rather than carried forward as a headline. Now weigh the risk against the reward. The bull case is roughly 42% above today, the base case the most likely about 18%, and the bear case a fall of about 16%, so you are risking about 16 to make 42. So, I'll call on Deckers Outdoor on the New York Stock Exchange, hold short term, buy medium and long. Remember, this is for education, not financial advice. Always do your own research. This analysis is by HOKA Investment at dohnatien.ca. The link to the full report is in the notes below. Have a great day.